Today, we're putting Asiri Surgical Hospital right under the microscope. We're going to perform a full financial autopsy, and what we find is a fascinating story of a company that's really living with two very different identities.
So on the surface, the story looks fantastic, right? The company reported a really healthy attributable profit of 370 million rupees. That's up nearly 21% year over year. It's a solid, impressive number that just screams thriving business.
But this is where things start to get interesting. Because in finance, there's the story a company tells you with its reported profit, and then there's the story told by the actual, hard cash that lands in its bank account. And for Asiri Surgical, these two stories couldn't be more different.
And here it is. This one, single, kind of brutal number, 0.48. That's their cash conversion ratio. What it means is for every single rupee of profit they claimed, only 48 cents actually turned into real spendable cash. Less than half. This is our kill shot, you know? The central mystery we have to solve is, where did the other 52% go?
Okay, before we go any further, just the standard but really crucial guardrail. This is a forensic breakdown. It's for educational purposes. This is not a buy signal or any kind of financial advice. We're just here to learn by taking apart the numbers.
So let's start with that official story, right? The profit illusion that the income statement paints for us. Because on paper, it really is a picture of perfect health.
I mean, just look at these numbers. You've got revenue up almost 10%, gross profit surged by 16%, and profit before tax, it jumped an incredible 24%. This is everything an investor wants to see. It signals strong demand, pricing power, great cost control.
And here is our first big pivot. On paper, this looks like absolutely fantastic growth, but it forces us to ask the single most important question in all of financial analysis. If these earnings are as good as they look, where is the cash? To find that answer, we have to look past the P&L and start digging into the balance sheet.
And that brings us to the balance sheet. This is where we start to see the company's hidden, second identity. It's not just a healthcare provider. It's acting as something else entirely.
Now, this chart, this is the first major piece of evidence. Just look at this. 38% of the company's total assets aren't in hospitals. They're not MRI machines, not medical gear. No, they are loans to related companies within the same group. I mean, get this. That slice is actually bigger than the slice for their core hospital assets.
Let's put a hard number on that, because it's huge. We're talking about 5.9 billion rupees. That is an enormous amount of capital that isn't being used to grow the actual hospital business. It's being used to finance other parts of the group.
So this slide just captures the company's identity crisis perfectly. Is it a 5.6 billion rupee hospital operator, or is it a 5.9 billion rupee group financier? The balance sheet is screaming that it's doing more of the second one. So how does this connect back to our missing cash?
Well, the answer is waiting for us in the cash flow statement. This is the document that finally connects the profit story with the balance sheet reality. We are following the paper trail to find our smoking gun. Okay, so on the income statement, Asiri Surgical reported earning 198 million rupees in finance income. A lot of that is supposed to be interest from those related party loans, and this income directly inflates their reported profit.
But here's the big reveal. You look at the cash flow statement and you see that of that 198 million, only 5.8 million was ever actually received in cash. The rest of it, it's just an accounting entry. It's an IOU from its sister companies that simply hasn't been paid.
So this is the core of it all, isn't it? The 192 million rupee question. This gap, this is the paper profit. It exists on the income statement, sure, but it never ever arrived in the bank account. It's the number one reason why that cash conversion ratio is so shockingly low.
Now think about it. If cash isn't coming in from your biggest debtors, in this case your own sister companies, you have to find cash somewhere else. And this chart shows exactly how they're doing it. They're waiting longer and longer to collect money they're owed, but to survive, they're taking longer to pay their own bills. They are essentially using their suppliers as an interest-free loan to stay afloat.
A structure like this always has a cost. So let's try to quantify the damage this lazy capital, all that money just tied up in these low-yield loans, is doing to the business and to its shareholders. First up, asset turnover, which is sitting at a really low 0.50. So what does that mean? It's simple. For every single rupee of assets on its balance sheet, Asiri is only generating 50 cents in revenue. And that's because almost 40% of its assets are just sitting there as loans, not actually working to generate sales for the hospital.
And of course, this directly hits shareholders. The return on equity is a pretty moderate 12.4%. It's not terrible, but you can just see how much it's being suppressed. Imagine how much higher this number could be if that 5.9 billion rupees were invested in high-return medical equipment instead of just acting as the group's private bank.
So after our autopsy, what's the final observation? Well, it all comes down to a clear, stark conflict between the company's actual operations and its bizarre financial structure.
And the final verdict is sharp. It's a buy the operations, tolerate the structure play. What that means is the core hospital business itself, it's strong, it's efficient, it's growing. That's the part you want to buy. But you have to live with this incredibly inefficient capital structure where a huge chunk of assets is basically dead money. That's the part you have to tolerate.
So the key takeaway here is pretty simple. Profit is an opinion, but cash is a fact. You always have to follow the cash. If you value signal over noise, join the circuit.